Good evening and welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to use guidelines to structure loans. We'll get started here in just a moment. Go ahead and drop a comment there in the chat as you tune in. Appreciate everybody tuning in nice and early. All right. Looks like we are live, so we will go ahead and get it started here. What we'll do is we'll take the chat off the screen for now, but go ahead and drop in your comments there and go ahead and drop any questions you have as well as Jose goes through the presentation here today. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on the show is a deep dive into a loan officer training topic. And tonight we're going to be talking about some very basic stuff, but the most important stuff, if you ask Jose, I'm sure. So we're going to be talking about how to use guidelines to properly structure loans. So Jose, the guideline master, I will let you go ahead and take it from here.
Good evening, everybody. Tonight's training, definitely one that brings warm fuzzies to my heart because, at the Mortgage Calculator, we are all about guidelines. We strive in our team of MLOs being loan consultants. We train them to be loan consultants and to be definitely sensitive to guidelines, be aware of the guidelines. The guidelines, especially for non-QM loans, will lead you to the promised land. And ignoring guidelines, not heeding the guidelines will basically cause your loan to crash and burn. So tonight's training is how to use guidelines to properly structure your loans. So we're going to teach you what basically the thought process that is involved in some of the intricacies. Because at the Mortgage Calculator, we are not a cookie cutter organization. That is why we are able to cater to such a wide range of borrowers, right? We are not just about agency loans. We have agency plus non-QM, fixed flip, ground up construction, commercial, and we know how to use it. That's the key. That is why we're having tonight's training on guidelines. So, first bullet point there, or my title there, determining the correct path is key. If you get off on the wrong foot, you're not going to get back on track. That is the key to using guidelines. Guidelines will make sure that if you do a proper job of assessing the data, you're going to pick the correct path, right? So as loan consultants, we need to gather the needed data to be able to provide the borrower, right, with the most accurate assessment possible. If you start on the correct trajectory, you're going to build credibility. And the result is you're going to meet or exceed your borrower's expectations, right? Under promise, over deliver kind of stuff. But in this case, we want to come across as consummate professional. Because conversely, if you get off on an incorrect trajectory, like I just mentioned, your loan is going to crash and burn. You're going to risk delays in your closing and possibly not closing at all if you don't have enough time to realign the loan, get it back on track. It was a purchase, supposed to close in 21 days, and all of a sudden you realize this can't be a full doc loan. This has to be a bank statement loan, or this can't be a bank statement loan. It has to be a profit and loss loan. I mean, mind you, situations can change when additional documentation is provided, but you want to get as much documentation up front so you can complete your accurate assessment. So some of the considerations here when determining the correct path is: are we going to go agency or are we going to go non-QM? Now, in the guidelines world, that's two totally different universes, right? The agency world is a world of homogeneous guidelines, or basically all the guidelines are the same. The only thing that really changes, which I'll get into in the next slide, is the overlays. And on your agency loans, AUS, automated underwriting, DU and LP, is going to dictate the documents required and the LTV, DTI, and credit score limits. Because on the agency loans, you're going to have your matrix, which is going to be for your manual underwriting type of stuff. That's your base there, and then you're always going to get that disclaimer that subject, credit score subject to AUS, right? So you don't really know what it's going to tell you, and DTI subject to AUS only, knowing that the maximum we're ever going to get is 49.9999999 on an automated underwriting conventional deal, for example. But anywhere between that 49.999 and whatever the matrix says on a theoretical manually underwritten deal is the area that you don't really know. But again, that has nothing to do with the guidelines. That's just AUS. In non QM, each investor has guidelines specific to their organization and their secondary market needs, right? Because these loan packages are sold into the secondary market, and depending on who you're selling that loan package to, are their guidelines, right? And then they turn around and pass those guidelines to us as the loan originator, and then we review them and see what loan we're going to be able to place you with, which is the beautiful thing about being a lender with all of these different options at our disposal. Like I mentioned, over 5,000 loan products at the mortgage calculator. And then the non QM loan is also going to be manually underwritten as opposed to the agency loan. And by agency, I'm talking about conventional, I'm talking about FHA, USDA, and VA. And the non QM loan is manually underwritten, where you basically are going to pick the program. So you need your borrower, self employed borrower, to qualify under a 1 year tax return option only. So pick the 1 year option, look at the 1 year option guidelines, and make sure your loan fits that option, and then submit your complete file. So, in breaking down the agency guidelines a little bit, I mentioned agency guidelines only vary due to investor or lender overlays, depending on if we're dealing with them as a non delegated correspondent lender, it's our investor. If we're dealing with them as a wholesale channel broker, then they would be the lender for some of the few options that we don't fund ourselves. But when you're considering agency guidelines, yes, they are homogeneous, but there are overlays. And then you got to consider, like I was mentioning, AUS and what it's going to tell you, the findings you're going to get. But then when you want to just check everything that's possible in structuring your deal, though, before submitting to automated underwriting. Then, if it's Fannie Mae, we got the link right there for Fannie. We got the link for the Freddie. We got the link for VA guidelines, FHA guidelines, and USDA guidelines. They're just a click away. And then, mind you, keep an eye on any overlays that the investor may have. And you get a lot of overlay differences in FHA, for example. We have some options where we can go down to a 500 credit score at a 90% LTV and not have it be manual underwrite, for example, if the system approves you. Others won't only let you go to a 550 credit score minimum. It really depends on the overlays. Others may say 600. So again, overlays are differences in what they accept, but not difference in the guidelines. So now non-QM, it's a little bit different, like I mentioned. The guidelines are investor specific and not product specific. So what that means is you cannot, it really wouldn't be valid to ask the question, for a DSCR loan, do you have to have XYZ? You're going to get a general answer there, because really it would be for a DSCR loan where you're considering submitting the loan under ABC guidelines. Can you do XYZ? Then we can review the guidelines for that specific option and see if it fits the guidelines and if it will work. And if not, then we look for other guideline options. The same thing you're going to find with all non QM loans, whether it be a bank statement loan, whether it be a profit and loss loan, full doc, whatever it is, they're all going to have different guidelines across the board. There is no homogeneous guidelines at all in non QM. So some of the differences that you could get now, I have here where it says option one, and then obviously the next slide is going to have option two. This is just where I put a sample guideline, and in this case, since we do so many debt service coverage loans, this I excerpt this guideline on debt service coverage ratio from one of our investors, and then you'll note how they treat when it's long-term rent, and then note how they treat when it's short-term rent. And one of the things to note when it's long-term rent, that they're only going to go with the actual rent reflected on either the lease agreement or the 1007. So if you have a 1007, which is a market rent study, that's all that they need. They really will not care that the current rent may be less from the current tenant, because you're going to be asked for either the 1007 or the lease. No lease is required to be presented on a refi of, and of your property, whether it's vacant or occupied, is not going to be an issue either, because they're going to go off of the 1007 market rent. The only time that you're really going to want to present the lease is if the lease amount is higher than the 1007. Then for the refi, you're going to show the lease in at least 3 months of receipt of the lease payment. And if it's a purchase, you can provide the current lease in the seller's name, but then the seller is going to have to provide proof of receipt of the last 2 months of the rent, which means their bank statements. They may not want to do that, but that is the option. Um, and then if we're using short-term rentals, for example, then they let you use the short-term rental revenue reports. They apply a 25% expense factor when using short-term rental revenue reports. And they let you put short-term rental comps directly on the 1007. Now, if you have short-term rental comps directly on the 1007, then that's it. No need to provide anything else there. No lease has to be provided. So that's a pretty flexible guideline there, as far as no lease has to be provided, because sometimes that can be an issue for some of our DSCR loans. So this is option number one, right? I showed you some differences there. And then this one is option number two, where in option one of option number two, that's pretty funny, right? When you're using long-term rents, they require a lease. For long-term rentals, when the actual rent as documented from the lease exceeds market, they're going to want 2 months proof. But this option requires an actual lease for using long-term rent. When it's a refinance, when it's a purchase, that's a different situation. They let you go with a 12-month look back period on short term rentals here as well. Uh, and they don't apply any haircut. In other words, there's no 25% expense factor. So that's pretty cool on that one. And they actually will also let you use AirDNA. The other option also let us use AirDNA, but this one lets us use AirDNA as well on purchases. occupancy rate must be 50%, whereas the other option I think said here, occupancy rate on AirDNA has to be at least 60%. So, it's those little tweaks to guidelines that if you don't notice it and you're like, oh, yeah, let's go with this option, AirDNA, and then all of a sudden your AirDNA is at 52%, and you're like, oh man, but if you would have, read that fine point there, you would have seen that this one only requires 50% on the AirDNA, no haircut on the 12-month lookback period, but is stricter when you're presenting short-term rentals on the 1007. They're going to ask um, the appraiser to comment on all different types of seasonalities and all that stuff. So there's more narrative involved here that you need to get a couple extra hoops of fire basically to jump through. But you see how the guidelines differ between one and the other. And like this, imagine how many options that we have. So again, the rate is one consideration, but the specifics of the deal that you need, the I's that need to be dotted, the T's that need to be crossed to make this deal work, that's where the guidelines come in, and that's where you can really excel as a loan consultant and provide the proper product for your customer from the beginning. And if not, of course, reach out to your team leaders for assistance. Now, how do we get about being able to properly use the guidelines, right? Well, we got to have an idea of all of these little twists and turns to the loan, different considerations that then we can review the guidelines. And again, this is not an all-inclusive list that I'm bringing up here, but again, this is about establishing the thought process. This is a methodical process where you're dissecting the loan, right? And basically each section is being treated as an individual section. And then in the end, you connect all the dots and see which is the best guideline to allow you to meet all of these different sections. So first, obviously, is if the property is a purchase or refinance, then you have seasoning requirements, right? Besides the value of the property and all that, that has nothing to do with guidelines. Guidelines is seasoning requirements, right? If it's an FHA loan, remember the FHA 90-day flipping rule. You can't get into contract until day number 91 of an FHA loan where the seller is reselling the property, a property that they just purchased. Day 91 is when you can legally enter into a contract. If it's a cash out refinance, another consideration is using the appraised value versus the purchase price plus renovation. That's another seasoning requirement. Cash out seasoning, that one is really all over the place on non-QM. Fannie and Freddie, it's set by the guidelines. FHA set by the guidelines. There's no overlays on that kind of stuff, right? The overlays, all that they can do is make it stricter. They can't make it looser, right? That's what overlays do. They tighten up certain parts. But here now, another consideration is when it's a purchase or a refinance, are you going to be required a CDA or a second appraisal? That's for non-QM. That could be a deal breaker. If you got that transferred appraisal already on a deal that you got, and you already checked your AVM, and the AVM works out as your secondary valuation source, you got a good deal right there that you can close. They got denied somewhere else. You're going to put it together as a bank statement loan. It was a full doc before, but you want to make sure that you don't submit it. If it's a large loan, you don't submit it somewhere where it's going to require a second appraisal. And then the second appraisal comes in lower, and now your deal is dead. So again, guidelines review. Property type is another consideration. Is it rural? Wow, isn't that one of the topics that can really kill a deal? And that's not always so easy to determine. Sometimes it's pretty easy to determine when you're reviewing the property's profile, but other times it's not, and it's strictly up to the appraiser. Does the property have ADUs, accessory dwelling units, right? We got DSCR programs that allow one ADU, but not two ADUs, and certainly not three ADUs. We just had one like that the other day, right? Single family home with three ADUs. Is it a non-warrantable condo, right? Does it have limited reserves? No, not enough reserves. Does it have too many renters? The renter owner ratio is too high. Um, those are factors that can easily be resolved either by a limited review condo or, depending on non-QM, different guidelines. We have guidelines on our non-QM for condos that do not ask for a condo questionnaire. They don't review reserves. They just ask for certain basic items of litigation and more than 15% of the unit owners 60 days or more delinquent, and that's it. So that would be one way to resolve that objective without you know going down this rabbit hole and not being able to find your way out. Right, pretty easy there if you know the guidelines and you review them. And then also property condition issues, right? You're here thinking, oh yeah, I can repair for, or excuse me, I can escrow for repairs in this loan, and you base everything on that assumption, and now all of a sudden, um, underwriter says, hey, your appraisal here is as is. There's $8,000 in repairs here. This is going to have to get taken care of before you can close. And here you were thinking, oh, I thought this had a repair escrow feature in this loan. You would have to find that out in the guidelines or in any overlays. Credit considerations, right? The obvious credit score, but also number of trade lines, no housing payment history on a borrower. That could be a big one there. Or credit events. What are credit events? Bankruptcy, foreclosure, short sale, deed in lieu, charge offs, collections. Those are all credit events, and different guidelines treat them differently. We have guidelines where if you have collections or charge offs, but you have enough reserves to cover those collections or charge offs, we don't even have to consider them, and they can remain unpaid. Now, that's typically found non-QM. Now, sometimes in AUS, you're going to get an automated underwriting approval on a primary residence where, at a lower LTV, that'll let you leave charge offs and collections unpaid. We've all had those as well. But on non-QM, you're going to find that out by looking at the guidelines. No need to run it through AUS to see if it'll give you that break. Other considerations, borrower, right? What type of borrower do you have? Is it a U.S. citizen, permanent resident alien? Sorry, I spelled that little typo there. Or non-permanent resident alien. Those are all, I would consider, the same category of borrowers in that they are legally authorized to work in the U.S. They have legal status to live in the U.S. They could all get all the same types of loans: conventional, FHA, USDA, VA. You got to be a veteran or active military. Is your borrower an I-10 borrower, right? Working here in the U.S., living here in the U.S., doesn't have legal status, has U.S.-based credit? Are they a foreign national borrower? Are they a first-time investor or a first-time buyer? Those are all important considerations that could totally make or break your deal, especially in the non-QM world. That is a biggie. And then income considerations. Is your borrower salaried or hourly? If they are salaried or hourly, is there any variable income component like overtime, bonus, commission, or tips, to name the four most common variable income types? Are there any income gaps on your salaried or hourly buyer? Remember, any income gaps more than 30 days or employment gaps more than 30 days have to be documented, explained, and the underwriter has to accept it. So you could get an automated underwriting approval with a 4-month income gap, and then the fine is going to tell you provide documentation for any gaps greater than 30 days, and the underwriter is going to have to decide if they want to do that. For your self-employed borrowers, is it full doc or alt doc? Right, that's the key, and you're not going to know that until you review tax returns, or maybe the borrower already told you, Jose, I haven't done tax returns in 3 years. Everything's on hold. My accountant's working with the IRS on all that kind of stuff. I have some unpaid tax liabilities that I'm trying to work down. So that's not going to be a full doc borrower where you're going to have to provide tax transcripts, record of account tax transcripts that's going to show that they owe taxes, $20,000 in taxes that they don't want to pay because they're working with the IRS with their CPA to get that amount reduced. So again, full doc or alt doc. Alt doc, are you going to go bank statement? Are you going to go P&L? Are you going to go asset utilization? Are you going to get full doc and add asset utilization? We have that in non-QM, and we actually have that in more restricted versions in agency as well, right? For 62 years and older borrowers that have a substantial amount of savings, you can add asset utilization to your W-2 or fixed income. Didn't you know that? And for non-QM, we could do that too. We could combine W-2 income with asset utilization. We can combine W-2 income with bank statement and P&L and asset utilization. If you have those 4 different income streams separately accounted for, we could actually do that at the mortgage calculator. And if all else fails, DSCR, right? And we all know the DSCR rates are coming in strong. And it's not just about the rates either. Remember, it's everything else. And it's not just about the no income. It's things like no seasoning options, short-term rental income, and other factors beyond the obvious that allow the DSCR programs to really shine like they do. And lastly, here, assets, right? Our last area that we're going to consider is assets, and very important, right? Because if you can't have the fund, if you don't have the funds to, verified to close, you're not going to be able to close. And different considerations are seasoning of the asset, right? How long has it been in the account? Some options require 60-day seasonings. Others require no seasoning because other options, some of our non-QM options, don't even require sourcing of large deposits. As long as it's in the account and it's not like a $240,000 deposit or something like that out of the ordinary, but just normal deposits, they're not going to question them. They may ask for an unusually large deposit just to make sure that it's not some kind of debt or something. But normally, our non-QM options give the best guidelines for seasoning and sourcing. Gifts, something else to consider. And if there is a gift, you got to know, because you got to help them structure the gift so that it's transferred from the donor to the borrower in a manner that's acceptable for the program. How many times have you seen they gave the gift in cash? Oh, yeah, I got a gift from my dad. Oh, yeah, sure. Let me see the documentation. Well, he gave it to me in cash. Okay. Did he pull the $5,000 out of his checking or savings account or mutual fund and then give it to you in that way? Gave you the cash that he withdrew from his account, so then you could track at least, hey, there's $5,000 withdrawn today. Here's a gift letter, and it was deposited in your account. But then the answer in those cases is not going to be that. The answer is usually, yeah, no, he just had some cash lying around and he gave it to me. And in that case, then that gift can't be sourced, and then you're going to have to wait for that money to season in the account before it can be considered for assets and before it can be considered for reserves, because reserves is another requirement, especially for non-QM, especially for DSCR and bank statement, all these alt doc loans in non-QM. They're going to ask for a certain number of months. It could be 3 months. It could be 6 months. It could be 6 months plus an additional 3 months for every property that they own. So again, there's a lot of different options that you could find regarding reserves, and that's because, again, like I mentioned, all non-QM guidelines are going to be specific to that investor and their secondary market needs. So whoever they're selling their paper to says they got to do, that's what they're going to tell us, and that's what we're going to tell you. So again, you saw here what we've done is we've established a thought process, why guidelines are important, how guidelines can differ, and then what are the different categories of the loan that you can look in the guidelines to try to get the guidance from the guidelines that you need to properly structure your loan. Don't see any questions.
Yeah, no questions. Guidelines, 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 right?
Well, definitely, this is a presentation that everybody should download, right? Keep it handy because, I mean, especially for the newbies out there, it's a nice little roadmap. And then, of course, also make sure you reach out to your team leaders for guidance so that we can help you structure your deals.
All right. Thank you, Jose. And we'll go ahead and wrap it up then. I still don't see any questions. So remember, we do this on Tuesdays, Wednesdays, and Thursdays at 7 p.m. Eastern Time with a new loan officer training topic. So we will see you on Tuesday, 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great